one of the things that frustrated me as a young property investor, being able to access the capital that I needed to grow my wealth was really, really difficult. And similarly, in a sort of parallel world, working at the bigger end of town, I saw how a lot of the commercial landlords do it. And you can't do this in the residential world, but in the commercial world, a lot of landlords get paid their rent in advance, sometimes quarterly, 6 monthly. If you look at a specialised asset like a service station that has a lot of capex, often it's actually annually in advance. But residential investors just don't have that possibility. So that was, I think, the genesis really for Futurerent.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You'll hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi, freedom fighters. What's your biggest frustration as a property investor? For many, it's the limit of their property purchasing capacity. They want to invest more and grow their portfolios quickly, but after a couple of properties, they're capped out because they either don't have the borrowing capacity or they run out of equity. And both are equally important to enable you to secure more property. For me, it all comes down to what I like to call the bare facts, where BEAR, as in BEAR, breaks down into borrowings, equity, affordability, and your sleep at night risk appetite. And the first two, the B and E, or borrowings and equity, determine your property purchase power. And the lowest of your borrowings or your equity drives how much you can pay for a property. What do I mean by this? Well, very simply, you might be able to borrow an extra $1 million based on your income and liabilities, which is where many first-time investors start, as they jump on an online borrowing calculator on a bank or other website and think they can borrow or buy a property for $1 million. But they're sadly mistaken, because your purchase price power is also determined by how much you need to contribute in equity. Now, equity is just a fancy word for the amount of savings and or available equity you have in your existing property or properties to cover the shortfall in the loan against the property, plus the establishment on costs that include things like stamp duty, bank and professional fees, conveyancing costs, adjustments to rates and taxes, etc. Now, in property terms, equity is the difference between what the bank thinks your property is currently worth, and sidebar here, it's generally 10 to 15% below what you can actually sell it for, minus how much you currently owe on it. Remembering that lending accessible equity is generally 90% of this value, less the balance of your current loan. So, as an example, if your property is valued by the bank at about $500,000 and your current loan balance is $350,000, then your available equity is $500,000 times 90%, which equates to about $450,000, minus the $350,000 loan, so your available equity would be $100,000. Now, in broad terms, this means that if you get an investment loan for 90% of the value of the investment property, including lender's mortgage insurance, which actually means you're effectively borrowing approximately 87 to 88% of the purchase price, then you need to have sufficient equity to cover the shortfall gap of 12 to 13%, plus approximately 6 to 10% for all of the establishment on costs. Now, the 6% is the bare minimum, But if you're also engaging independent property strategists, buyers agents, building and pest inspectors, etc., then you need to budget for approximately 10% on costs. So, as an example, on a property purchase price of $500,000, you need to come up with a deposit from your savings or accessible available equity in your existing properties via interest-only investment loans against them to cover the $65,000 in loan shortfall plus the $30,000 to $50,000 for the on-costs. This means that on a worst-case basis, you need to have available equity of $110,000 to secure a $500,000 property. Now, these are worst-case numbers, and an investment-savvy mortgage broker like our know-how property finance architects are able to access special lenders and lending solutions, and they're often able to come up with creative ways to reduce your equity contribution to help you secure a property. But even on a best-case basis, you'll still need to be able to access a deposit of somewhere between $65,000 to $75,000 to secure a $500,000 property. And here lies the looming problem for most investors, because after roughly 2 to 3 properties, they hit the capacity ceiling because they either run out of borrowing capacity or they run out of equity, or a mixture of both. So it's clear that your achievable borrowing capacity as well as your access to equity can have a massive impact on your ability to continue to secure residential investment property in order to grow your portfolio. Now, we'll put your borrowing capacity aside for today, as I'll dive into how you can improve your borrowing capacity in a future episode, except to say that your biggest asset when you're getting a loan for an investment property is your borrowing capacity, not the interest rate of the loan, which is unfortunately what most investors, brokers and banks tend to focus on. Now, while we're on the subject of borrowing capacity, you may be surprised to hear that there's a 55% variation across the lenders in terms of how much you can borrow based on exactly the same income and liabilities profile. To illustrate this is the difference between being able to secure a property for $500,000 and securing a property of $775,000. And if they both enjoy capital growth at the same average rate of, say, 7% over the next 20 years, then the difference between maximising your borrowing capacity versus chasing the cheapest rate will have put on an extra $790,000 in your back pocket, all by just maximising your borrowing capacity instead of focusing on the lowest rate loan. So again, make sure you're working with an investment-savvy mortgage broker who has access to specialist lenders that can significantly boost your borrowing capacity. But I digress. Let's get back on the topic of equity, given its similar impact on your ability to secure additional properties. If you're an existing investor who has already tapped out on your savings and you've used up all of your accessible equity in your existing investment properties and or your home by taking out investment loans against them of up to 90% loan to valuation ratio, including the lender's mortgage insurance costs, how can you access sufficient additional funds for the deposit on your next property? What are your options? Well, unfortunately, they're limited. You can start saving furiously by living on a budget of baked beans and dog food to put away an extra $75,000 to $110,000, but this is likely to take you years unless you're getting large, lumpy and consistent bonuses. You can wait for your existing properties to go up in value sufficiently to create the equity deposit, which may have been the case over the last 12 months due to the 20 to 30% rise in property values, but this is the exception rather than the rule. And it generally takes 5 years plus to see this level of property value and equity increase. You can roll the dice and investigate the time and headache of refinancing with the possibility that another lender's valuation will come in higher and give you enough equity for your next deposit. You can get a contribution from the bank of mum and dad, who may be able to access equity in their property to give you the deposit, or you may be able to get a good friend or colleague to do the same. But both of these come with inherent risks for you and them, and they need to be very carefully documented. You can also sell an existing property to avail funds for your next purchase, but this is costly and a taxing changeover, and doesn't allow capital growth accumulation to build your wealth easily and affordably. Or you can try to take out a personal loan, but this is expensive and really chews into your borrowing capacity. So if you're taking this option, you're often robbing Peter to pay Pauline with this approach. So where do you turn in order to get your hands on the required deposit funds? Apart from the options I've just mentioned, there really aren't any other cost-effective alternatives, or at least there hasn't been until now. And this is where today's special guest Godfrey Dinh and his disruptive industry innovation of Futurerent comes to your rescue. Godfrey's an experienced property investor on a mission to revolutionise residential rent. He's over 15 years' experience in property investment and finance both professionally and personally for organisations such as Deutsche Bank and Investec, as well as buying and selling his own investment properties in Australia and the US, which led him to create Futurerent, as you'll hear in our great chat today. So what is Futurerent? Without stealing Godfrey's thunder during our great reveal in today's awesome conversation, Futurerent gives you, as a property investor, your rent in advance, giving you access to up to $100,000 for each rental property you own, fast and simply, to help purchase another property, or you can access up to 1 year's rent in advance if you're looking to renovate your home or the investment property, invest in a business, or buy some shares as some examples. Created specifically for property investors like you and me, Futurerent is a loan-free financing solution with no interest, no hidden fees, and no credit impact. And you can access these monies in just 2 business days. Now, Godfrey and his team have cut out all of the typical drawbacks of traditional finance, as they simply provide investors with access to their rent in advance, rather than have to jump through all of the hoops while being a contortionist to lend money from a bank. And the good news is that you still receive ongoing rental income throughout the term, and you have the ability to pause instalments if your tenant vacates and stops paying rent. So if you're a property investor who's looking for quick and easy access to equity funds to secure your next property or for other worthwhile purposes, check out futurerent.com.au. And if you're fired up about taking your property investment to the next level, no matter where you're at, whether you're a beginner or a seasoned investor that's struggling with your portfolio, I'd like to invite you to join me on our unique Know-How Property Freedom Formula Flight program, where I'll personally guide you through my proven process for property investment success. And/or we can complete a review of your current portfolio to see how you can improve it, how you can reduce your costs, reduce your risks, and how you can increase your property purchasing capacity. To book your ticket or to find out more, just jump on knowhowproperty.com.au/freedom fighters. And if you want to hear more from Godfrey along with all of Australia's leading property investors and independent professionals, join me and the other 120,000 plus regular listeners every week as I anchor host the country's most popular and longest running property show, Realty Talk. So I look forward to seeing you on channels.realty.com.au/Realty Talk, where we share short and sharp take-home tips and tricks on all things property. In the meantime, enjoy this ear-opening conversation with Godfrey Dinh. Hi, Freedom Fighters. Now, traditionally, one of the biggest challenges that you face as a property investor is the inability to grow your portfolio quickly due to the difficulty in accessing equity easily, fast and affordably. So, for anyone who invests in property, you know that it's expensive and often your equity is tied up, which makes it hard, time-consuming and often stressful for you to make your next investment unless you refinance or sell existing properties. But as an active property investor, you're likely to be ambitious with goals of buying more property or renovating existing properties ASAP. So how do you overcome this significant financing hurdle? Well, what if there's a better funding option than refinancing to achieve this, that avoids the endless and expensive paperwork, the extensive delay times, the expensive costs and fees, as well as the impact on your credit report? Well, that's exactly where today's special guest, Godfrey Dinh, the CEO of industry innovator and disruptor Futurerent, comes in, with this exciting new funding innovation that we're going to reveal and unpack today So welcome, and let's get invested, Godfrey.
Thanks so much, Bushy.
Mate, been looking forward to having this chat since you and I first connected on Realty Talk recently. And I sort of want to do a really big deep dive on the exciting innovation that you bring to the table. But before we get stuck into that, I'd sort of love for you to just give us a quick intro on who you are, what you do, and most importantly, why you do what you do, please, mate.
Yeah, so I'm the founder and CEO of Futurerent. And that's, in short, basically a loan-free alternative for property investors to get up to $100,000 of their rent in advance. I do what I do because property investing is really, I think, the number one way that everyday Australians secure financial independence. But generally, property investors have been deprioritised by the banks, and access to finance is generally their biggest issue. Accessing 50,000 is as difficult as getting 500,000. So we really wanted to provide a better funding solution to help property investors grow their wealth.
Love it, and we're going to have some fun really diving into the details of that shortly. But before we do that, mate, I'd love for you to take us on your personal journey so far and go back as far as you'd like and talk to us about where you've invested your own time, energy and money. Where has it led to you? What have been the highs and lows? What have been the learnings? And how has that brought you to what you're now doing?
Yeah, so to go back to where it started, I actually studied property economics at UTS. And I started working for Investec and then later Deutsche Bank in their property investment and structured finance areas. And I was a super eager young property investor. So, the minute, and I was still at university when I started working, I was on one of those sort of grad program, undergraduate program things, and, managed to save up a little bit of money and bought my first investment property, which was a house on a decent sized block of land in Ermington. This would have been 2006. And the land was big enough to subdivide. So I always thought, great, I could, when I have the money, I could subdivide this property. But even though I was in a, decent job, albeit a young guy, on a decent income, I never managed to save up the money to do the subdivision work. So I ended up just prioritizing different things. And as a result, I never did that subdivision. I ended up, I held onto the property for a number of years, then I sold it, made a little bit of money, but the next buyer came along, subdivided the block, and, made a decent amount of money. That was really sort of one of the things that frustrated me as a young property investor. Being able to access the capital that I needed to grow my wealth was really, really difficult. And similarly, in a sort of parallel world, working at the bigger end of town, I saw how a lot of the commercial landlords do it. And you can't do this in the residential world, but in the commercial world, a lot of landlords get paid their rent in advance, sometimes quarterly, 6 monthly. If you look at a specialized asset like a service station that has a lot of capex, often it's actually annually in advance. But residential investors just don't have that possibility. So that was, I think, the genesis really for Futurerent.
Yeah, got it. Perfect. Well, I'd like to sort of circle back and dig in a little bit deeper to some of that, if you don't mind, before we sort of get stuck into the nuts and bolts of Futurerent. And the first question I'd like to sort of better understand is why property? I mean, where did that initial interest in property emerge, and before you even made the decision to do property economics?
Yeah, for me, what attracted me to property was, firstly, I like the fact that I can look, see, and understand it. But secondly, what really drove me towards it was, your ability to really influence your outcome so much more than if you were just investing and buying shares in the share market and you're just one of thousands of investors with no influence or control and no visibility. I think, to do really well in any sort of investment, there needs to be a little bit of sort of, I guess, an edge. You need to really have an edge.
Yeah.
And getting an edge in, for instance, like the equities markets or something like that is really, really difficult. Whereas property is something which, because the information is a little bit more opaque and the markets, I guess no two properties are the same. It's a very, heterogeneous sort of market. Your ability to do well and your ability to control your own destiny is so much greater. So yeah, I think that was like a big influence for me, and I was introduced to a couple of people who had sort of done the course, and it sounded like sort of a really interesting career path, and an area where you could actually achieve financial independence off your own back.
That's a fairly mature insight for someone at a fairly young age, mate. What sort of a pond were you swimming in to be able to sort of come up with that sort of revelation? Because a lot of people don't get to that point until they're sort of a lot older. Was your family heavily involved in property? What was the sort of environment that led you to get to that point so quickly?
Well, I think I grew up in probably a very sort of standard Australian family in the northwestern suburbs of Sydney. So my dad actually moved to Australia from Vietnam in the 70s, just before the fall of Saigon. And my grandfather, he was actually a self-made sort of architect, builder and developer in Vietnam. He was actually very involved in the revolution when Vietnam was initially fighting for independence from the French. As a result of the war, his family actually lost everything. So they went from being one of the wealthiest families in Saigon to actually one of the poorest. I think that influenced my relationship with money in a way where it made me realize that money can really come and go, but you're your biggest asset, and it's all about what you can do, it's very much so about you and your journey as a person. So I think that influenced me to a degree where I sort of saw property as something where you could really sort of carve out your own destiny and your own journey. But other than that, like my parents, I think they bought a couple of investment properties when we were growing up, and that for them was probably I think really materially in terms of being able to provide for their retirement. But they weren't big property investors in any way. So it was probably more just like a kind of awareness of the family history that sort of made me think this way.
Yeah, love it, mate. I've been very fortunate in a way. I mean, and it's, I'm not belittling at all the obvious challenge that your grandfather went through. Must have been a very testing time for the family in Saigon, but some really important learnings that have come out of that have clearly influenced you and your direction at a relatively young vintage. So you did some work with Investec. I also understand you then joined Deutsche Bank and rose to some pretty serious heights fairly quickly with some significant monies under management. So talk to us a little bit about that experience.
Yeah, so I mean, I sort of worked my way up. I started at the very, very bottom, and when I left, I was vice president of Deutsche Bank's commercial real estate business here in Australia. So I, over my time, invested about 1.3 billion for the bank into property deals. That's between Investec and Deutsche, and we did some really interesting things. So there was a lot of actually sort of opportunity around 2010 to 2014, where some of the banks were exiting, some of the European banks post-financial crisis were exiting the Australian market and selling their positions and a lot of bad loans. And situations that we could basically take over and sort of fix a lot of these broken assets. So it was a great learning opportunity, and I think it allowed me to, at scale, get a lot of experience with property deals that I would never be able to, in a million years, have the amount of capital myself to, do those sorts of transactions and deals and get that kind of experience at scale. So I think that was, a brilliant way to sort of start a career and go really, really deep and get a lot of specialized knowledge, which, was a fantastic start.
Yeah, love it. Well, let's look at the parallels with that, because you sort of mentioned your first property investment was a house in Irvington that you just physically and financially weren't able to subdivide given the limitations of what Resi will let you do. Take us further on your own journey, because I imagine if you're playing with big numbers in big projects in that commercial arena with Deutsche Bank, for an early time investor, they'd be like, okay, well, this is going to be pretty easy for me given the comparison between the two and the scale of what you were dealing with. But often not the case when it comes to the cut and thrust of residential. So take us further on your own personal investment journey in terms of what you invested in, why, and what were the highs and lows and the outcomes.
Yeah, so probably the biggest change for me came about when I left the corporate world. So, and that really happened by chance in some ways, because I was actually initially planning on moving overseas to work in private equity over in the UK. And I had a couple of months off because my sister was getting married. So I was in the US visiting some friends and started looking around at property. I just couldn't switch off, and started to think, wow, there's actually like some decent yields and some good buying opportunities in the US. So this was 2014. So 2014, I actually thought that the market in Australia was overheated, and I was, obviously wrong. There was a lot more gas in the tank, and the Australian market went on and on and on. So I actually sold. I'd sort of sold everything. I sold my house and sold my car, sold everything in storage, and I was in the US, and started then thinking, oh wow, hang on a sec, this actually looks quite reasonable. So I bought a multifamily property in Boston. Right near the university, it's a big university town there, so right near Northeastern University. And so basically that's just like a block of units with a couple of units in it, which you rent out to university students. Yeah. And the yield's good. So the yield was better than what you could get in Australia. We were getting about a 7% gross yield. But the thing that, I didn't really appreciate was obviously access to finance is just the biggest thing. And this is probably the mistakes that I made. So over there, you can't qualify for, the same loans as everyone else. But I was able to qualify under like a commercial style loan, because we were essentially buying more of a commercial style property. Yeah. But that means lower leverage, right? So we got about 60% leverage. We're paying a touch under 5%, and we'll grossing about 7%. So, we're making a bit of a yield on the equity, but not great. Yeah. It was one of those things which I think as a result of, for instance, even the leverage meant that I did way less than what I would have been able to do if I'd just taken that money and invested it in Australia, right? Yeah. And as well, it meant that recycling that capital was a whole lot harder, because the asset was in the US, and if I wanted to do anything else in Australia, you can't really do the same things that you would do if you had that equity here in Australia. So I think in some ways it was amazing, because it sort of put me on a path which was more of an entrepreneurial path.
Yeah.
Where I went on and set up, my own, or with a couple of other guys, like a commercial property investment and advisory business. And that was terrific. But in other ways, that investment itself came with a big opportunity cost.
Yeah.
So, the business we had here would do our own small deals, but with a reasonably limited amount of capital, and then would help other developers and commercial investors with bigger deals. So we were constantly trading properties, right?
Yeah.
We're constantly trying to find something that needs a bit of fixing, needs a bit of love, and you can improve the rents or improve the values in some way and sell, right?
Yeah.
You make money, but the problem with that is that after taxes, the profits, they're really not much better than a salary.
Yeah.
So you're actually just constantly on the hunt for the next deal. So I should have been more focused, I think, on how we could buy, fix, and keep the real estate, right? And that was one of the other factors that made me realize, like, that inability to access capital is such a limiting factor, and the power of being able to access your rent in advance, which is now, of course, what we do, for investors around the country.
Yeah. Yep. You still hold the US properties?
No, we sold, and look, we made a little bit of money, but not a fraction of what we would have made if we had invested that money in Australia. You just look at what the market's done locally here over the same period of time. It's just been unbelievable.
Yeah, I agree. The reason I asked that, I've got properties in the US myself, and it's been a very interesting ride. Godfrey, to say the least. I went a little bit earlier than you when the GFC hit. I just thought this is a once-in-a-lifetime opportunity given how low property values were in the US at the time. So we jumped on a plane and spent 3 months over there really getting a feel for the market. And while it's been okay, it's been very challenging given the time differences, but more importantly, the lack of professionalism that we experienced in the industry players over there compared to what we were used to here in Australia. We are head and shoulders above the rest in my own experience as far as that goes. I'm not sure how that went for you.
Yeah, I think that's right. I think there's a lot of things we think that the US is, and in many ways it is very, very advanced, but in many ways it's also caught in another century. Like, tenants still pay their rent by check. I don't know if you're still getting checks, but we're getting checks, right? I think that there's a lot that in property comes down to really knowing your own backyard, and having those local connections and having that local knowledge, which is just really difficult to do well if you're only there for 3 months or if you're only there, part-time.
Yeah, no, it's a good read. So tell us about your ongoing personal journey then. So you're certainly, from a business perspective, doing some active work in the sort of flipping exercise essentially, which you clearly learnt reasonably quickly has got hairs on it when you look at the amount of risk for the sort of reward that you're returning. Did that change your both business and personal investment strategy to more a hold type approach? Tell us about where that led you from there personally.
Yeah, I think for me that really led me to realise the problem that I was facing, and that was really the genesis for Futurerent in terms of thinking, well, what should people be really doing? And I think it's really about buying, fixing, and keeping assets, right?
Yeah.
Because when you keep the assets, you're able to get that capital growth over the long term. It's really just even inflationary pressure that with leverage generates you the real returns in property.
Yeah, totally. Exactly right. It certainly takes a lot of the pressure out of it and allows you a fair bit more time to put into other activities. So talk to us about then that next step. was both from the personal and professional side of the equation that directly led into Futurerent. Is that what I'm hearing?
Yeah, so I sort of started thinking about all of these things and my own frustration as a property investor and my own inability to, pull the capital out of the deals without selling them and incurring a huge amount of tax and incurring a huge amount of friction costs in the whole process. And it made me think, wow, there's actually no one out there that's supporting property investors and giving property investors something that's built for them and a solution that gives them easy access to the money that they need so they can grow their wealth. So it was a combination of all of those experiences and my experience, personally and professionally, that led me to come up with the idea for Futurerent.
Yeah, I love the whole concept. So let's do a deep dive onto that now, Godfrey, because it's certainly an exciting innovation that is really going to open the ears of the listeners. So in really simple terms, and just to break it down, what is Futurerent?
So, Futurerent is a loan-free alternative to the banks. So it gives property investors $100,000 of their rent paid up front, and we're just giving people easy access to the money they need so they can grow their wealth.
Yeah, love it. It's in elemental terms, it's such a simple concept. It's one of those you think, well, why hasn't someone done this before? And that's often the case. So you've been smart enough to leap into that space. So if we sort of just stating the bleeding obvious, what's the real problem that Futurerent solves?
So it's all about access to finance. Access to finance is the biggest issue for property investors. And really there's three problems with it. It's complex, it's painful, and it's not fit for purpose. Generally the banks have made borrowing money harder and harder. So they've been laying contingency on contingency, and a lot of these are inappropriate in the short term. So for instance, even recently there was the increase from the 2.5% buffer to 3% buffer, which isn't actually about responsible lending. It's actually about artificially trying to restrict prices, right? Yeah. But it comes at a cost, and that cost is people's ability to borrow money that they can actually afford. Yeah. The banks have really made borrowing money a terrible experience with the paperwork, the wait times, the impact on your credit. But property investors just haven't really had a choice. When you're in a position like I was, your only option generally is to refinance or take out a personal loan or otherwise sell to get access to the capital you need. Yeah. And often those things are just painful or impractical.
Yeah, I agree. I've often jokingly said, Godfrey, that, and I think this is a quote by the US comedian Bob Hope many years ago, and that is that the banks are only prepared to give you money if you can prove to them that you don't need it.
Yeah, exactly.
It's a crazy setup, I think, and you're absolutely right. The layer upon layer of policy restriction that has now been brought into play forced by APRA and ASIC and every other regulatory body has made it very challenging, and unfortunately, property investors have been demonised in that whole process, quite unfairly, I think. As being the cause of the blowouts in property values across the country. If we look at what's happened in the last couple of years with COVID, it's been an owner-occupied led growth cycle, but unfortunately investors tend to cop the nasty end. Maybe it's just favourable because, from a voting perspective politically, it's easier to kick an investor than it is to have a go at vote getting owner-occupiers, but certainly the whole industry is lacking an opportunity like Futurerent to really open up the gambit so that investors can continue to grow their portfolio without going grey, trying to manoeuvre through the minefield of the lending environment. So let's
100%. Yeah, it's purely political. And it actually bears no impact on the actual reality of it all. It's a supply issue. right? If the government wants to control prices or rein in prices, they need to address supply. It amazes me that they haven't done anything, more significant yet in this regard. There was a white paper a few years ago on medium density development, which basically proposed, look, as long as you comply with certain basic standards, then you don't need to go through a whole DA process. You can submit under a complying development for decent medium density development, which really is just updating a lot of the stock which is no longer relevant, where someone doesn't need to have a house with 1,000 square meter block of land. That ideally should be a couple of townhomes or something more appropriate for a growing population. But the whole issue has become politicized, and the ridiculous thing is that the property investors themselves don't fit that stereotype that the media really tries to portray, right? 90% of property investors, and certainly all the people we speak to, are regular, hardworking Australians who are simply trying to plan for their retirement and their financial future.
100% agree. And what astounds me is that, given that anyone with that's been in the game for 5 minutes knows that relying on paying off the home and sticking money into super is going to destine a lot of hardworking Aussies to penny pinching poverty when they get to retirement, you would think that they'd be getting right behind property investors, because their ability to self-fund their future is going to take a lot of pressure off the public purse in having to fund that long term. So it always confuses me that, but this is where the short-termism of politics gets in the road of long-term decisions. But I digress a little bit there, Godfrey. But mate, well, let's drill back into Futurerent then and get you to break us down exactly how it works.
Yeah, so I guess we give property investors up to $100,000, right? But our most popular product is someone gets a year's worth of rent upfront, and that's paid back over 3 years from a third of the rental income. So that way the landlord still gets 2/3 of the rent, less our cost, which is 6% of the rent. So they're still getting over 60% of the rental income. So the basic process is someone applies online in probably 2-3 minutes. It's really basic info. And we basically, we get everything else that we need from the property manager. And we can do that because you're not borrowing money when you deal with Futurerent. So as a result, we're not assessing you as an individual. So like a lot of people think that it depends on how long he's left on the lease. It actually doesn't matter. Even if he's vacant or month to month, you can still get a full year's worth of rent up front for any reason. And then if the reason is actually to help you buy another property, you can actually access 2 years rent up front. So that can be really significant and powerful in terms of giving people that access to capital.
Yeah, love it. That's certainly going to go a long way towards the deposit that they can't access with equity that's locked up in the other properties that they just can't jump the finance hurdles to get their hands on. So are there any, what other, and you mentioned a very important point there, I think, that clearly for your own risk management perspective, there needs to be a professional property manager involved to give you confidence around both the rental and the management of the property. Are there any other key criteria there that need to be met to satisfy your requirements?
So really all we need is, professional property manager to be in place. We do a credit check, but we do it as a soft check, which doesn't leave any footprint on the file. Yeah. And there we're really just checking that, the people we're dealing with are currently sort of meeting their repayments and they're not in any, financial difficulty. But otherwise it's a really seamless process.
Almost sounds too good to be true. So I know the listeners will be going, wow, the idea of upfront rental payment seems absolutely fantastic. what's the catch? What's your response to that?
Yeah, I mean, it's just one fixed cost, so which is basically just 6% of the amount advanced each year. So that's all it is, and it's terrible that there's actually that kind of response. I think sometimes with people, and that's because people have become almost accustomed in financial services to expect a catch, right? Because there's all of these fees and all of these different charges and all of these crazy terms and conditions. And we've tried to design something that's completely the opposite of that, where we're giving people simple access to the money they need in the form of rent that they can use for whatever they want, right? It's I think if anything, there's probably, when you think about the alternatives, which are really refinancing, is the biggest alternative, of topping up your loan or refinancing. It's actually there that most of the catches lie, where most people don't realize this, but if you're doing a top up, you're probably going to pay about $2,000 just in costs to set the thing up, right? This is in terms of valuation costs, application fees, all of the hidden charges that are buried in the fine print. And then, the actual cost of that money, even if you think you're getting like a great headline rate, you're like, oh, look, I'm borrowing at 3%, that 3% is so much cheaper. Most people, they just say they need an extra 25 grand. They top up their mortgage with that amount, and that ends up costing them over $15,000 in interest over the life of their loan, because that interest just keeps eating and eating away. So yeah, I think it's this unfortunate reality where people sort of expect the catch, but something that we've really intentionally designed away from.
Yeah, I love it, because I mean, looking at the broking side of our own business, in the current day and age, and it didn't used to be this, but given the changes since and before the Royal Commission, just to get a 25 grand top out, you've now got to go through a full application process. So there's, as you say, there's money there, there's time there, but there's stress and complexity around the exercise, because you're reassessing, you're revaluing, which has a number of risks attached to it, and quite often, where investors are looking to access equity, they're crossing the border into lenders' mortgage insurance territory, which then adds a further complexity around the approval process, but also another significant cost that then gets amortised into the loan, and that 15 grand that you spoke about over the life of the loan is substantially increased because of the lender's mortgage insurance impact on all of that. So certainly, what you're offering is just such a clear road to accessing funds quickly, simply, without the stress. Absolutely love it. Now, you're sort of emphasising the fact that you're really building Futurerent for property investors. In above and beyond what we've already spoken about, what does this actually mean?
Yeah, so I guess it means that we've got a lot of things that are built in that are designed specifically with property investors and their needs in mind. So, for example, if your tenant moves out midway through the tenancy, if you were borrowing the money, you'd still need to make the payments. But with Futurerent, the repayments actually pause, right? So we're giving you rent up front, and we're repaid from that rent as and when it comes back in, right? So that's a big one, and then you're actually you're not borrowing money, you're just accessing your rent up front. Yeah. And that means that to put people through any of the usual rigmarole.
Yeah, I love it, mate. It's just the simplicity of it is supreme. Now, you say that Futurerent is interest-free, so apart from that 6% cost, how else do the repayments need to work?
Well, the thing about that 6% cost is we actually do that to effectively fix the cost. So say, for instance, you decide that you want, say 100 grand, and you've got a nice investment property that's rented for $2,000 a week. So you want 100 grand and you want to pay it back in 18 months. Then what we'll say is okay, well, the cost of that 100 grand over 18 months is $9,000 in rent.
Yep.
Right? And if that then takes, 24 months to pay back because there's some vacancy or there's some issues, it doesn't cost you any more than 9,000, right? So it's not interest that can compound and snowball and where you don't have any visibility into, what the ultimate cost will be. It comes at just basically a fixed cost, and there's no interest and no other fees, no late fees, none of those things that you'd ordinarily see.
Absolutely love it. So what are the main use cases for Futurerent with the clients that are currently using their upfront rent mode?
Yeah, it's really about, in the main, wealth creation, right? So that's in the categories of like renovations, both people, renovating their own homes and their investment properties. And then people buying additional properties. And that's, again, both investors and then owner-occupiers as well. So people who are, for instance, rent investors who are then looking to use the capital to buy, their first home. Even the bank of mum and dad. We're seeing a lot of, parents who have an investment property who want to help their child with the deposit. And, this is a really simple, clean way to do it. So, then there are also things like, for instance, people investing in small business. Small business lending is really expensive and really, really difficult, whereas this seems to be a great option for people. And then other things like investing in the share market, again, a better option than, a margin loan or something like that. To give you some examples, like some of the returns that people are getting using Futurerent really cleverly are phenomenal. So we have a client, for instance, Darren, who has an investment property up in Darwin. And he spent $25,000 on a simple, pretty cosmetic renovation, and he managed to increase the rent from $500 to $800 a week. So that's an extra $15,000 a year, right? And that's every year, 60+% return on investment. Most commonly, obviously that's big. Most commonly, we see people maybe spending $20,000 on a reno and getting an extra $100 to $200 a week. But that's 20 to 50% a year, right?
Massive.
Yeah, which is huge. Plus, obviously, it often then leads to higher valuation, which helps what you can do with the bank, and helps your refinancing strategy and all the rest of it.
Totally. So just allow me to ask this probably a dumb question, or might appear to be a dumb question. So what I'm hearing is that there's pretty much no limits on, providing they satisfy the criteria, there are no limits on what they spend the money on, or am I misreading that?
No, that's right. So if you're getting a year, you can access a year's worth of Futurerent upfront for any reason. If you're looking to, purchase an additional property, you can access 2 years. But otherwise, there's no restrictions.
Love it. It's just, a magic opportunity there, mate. So, okay, well, you've given us a couple of examples already of how Futurerent works. How do you think Futurerent is used most effectively then by the clients that you've seen today?
Well, I think it's when they use Futurerent in a really deliberate way with their overall financing and investment strategy, right? So, for example, at the moment there are some really incredible low fixed rates, right, where you might get 0.5% less or sometimes maybe more by getting that fixed rate. But a lot of people, they're on a variable rate purely because they want the flexibility to maybe change that in the future, right? But if you know that you don't plan on selling and you're in it for, the next 3 or 5 years or however long you're going to fix for, then, you're much better off sort of getting a great low fixed rate and then dealing with your more short-term needs and your investment capital with something like Futurerent. To give you an example, we have a client in Southwest Sydney who told us that he was able to basically fix his rate at like just over a 50 basis point discount to what he was paying on his variable rate. And then basically his whole strategy is around dual income properties. So buying properties on blocks of land that are just big enough to add a granny flat, get that extra, $350, $400 a week, right? And then use Futurerent there again to recycle that capital and do it again and pay for the next deposit and the next granny flat. We have clients doing, similar things all around the country. Another client who, does it really well in Canberra, where, in that area in particular, there's been a lot of rental growth recently, and some other areas like the Central Coast, where sometimes I think, rents can almost be a bit of a leading indicator for prices as well. And where you use Futurerent with that, especially that sort of dual income strategy, I think you can do incredibly well.
Yeah, love it. Well, can you sort of run us through some of the numbers on Futurerent, and then as a flow on from that, summarise the key benefits?
Yeah, so say for example your rent is $3,000 a month. So the whole proposition is, instead of getting that $3,000 a month, get $36,000 upfront, and you can pay back that $36,000 or that 1 year's worth of rent over 3 years from about a third of the rental income. So that means that each month $1,000 goes to repay Futurerent, which leaves you as the owner with $2,000, less the cost, which is 6%, so $180 each month. So you as the owner, you're still getting $1,800 every month, which is over 60% of the rental income, right? But what it's allowed you to do is bring forward that rent, right? And when sort of people think about the cost, I think a couple of things to note. So firstly, the cost is effectively tax deductible in the sense that you're receiving less rental income, which reduces your rental income and then reduces your declarable income, right, by that 6%.
Yep.
But what it allows people to do is it gives them the equity they need so they can make their next move, right, and they can work that rental income harder. And, to put it in terms of numbers, say, for instance, like the average yield, say 3 to 5%, or to make the numbers easy, say 5% if you're buying a property on like a 5% sort of yield, right?
Yep.
But we're giving someone sort of 5 to 10% of the property value, right?
Yep.
And it's costing them 6% of, say, that 5%, right? So it's costing them maybe 0.3% of that property value every year, right?
Yep.
So say, for instance, the property goes up in value by 3% each year. You're making 10 times the cost of Futurerent every year.
Yeah, it's a great way to put it. It puts it in much more perspective than, and this is the old trap. People get stuck on rates without understanding what the actual cost position is. So a very important distinction to underline there. You touched on the tax treatment. Let's break that down a little bit, because that will be something that I know a lot of interested parties will want to understand better. Can you just sort of drill down into the tax treatment in a bit more detail?
Yeah, so how it works is, even though you're getting the money up front, that is spread out over the life of the deal. So say, for instance, you get a year worth of rent up front. Instead of you being taxed on that all at once, you're taxed from an income tax perspective progressively. So you'll recognise, a third of that income in the first year, a third in the second year, and a third in the third year, right? Yeah. And then the cost of Futurerent being that sort of 6% that's going to Futurerent, that's rental income that you're not receiving. So it effectively then reduces your taxable income, which reduces the amount of tax you pay.
Yeah, of course. Yeah, love it. By effectively a third. So that's pretty substantial in terms of, depending on the income position of the actual investors, potentially that's going to keep a fair bit of their own hard-earned in their pocket as a consequence of that, and so you sort of get the flow-on effect as a result of that. No, I love that, mate. I love that. Yeah, that's really exciting, mate. There's ample opportunity there, very easy process. What's next for Futurerent then?
Yeah, so we're really in the scale-up phase. I mean, we're national now. We've got some really solid foundations. We've got a great team. We've got like a $20 million debt facility that is sort of helping us keep up with the demand that we're experiencing, and so yeah, we're really just going to continue to grow out the business and help property investors with their goals. But we're also, sort of building out or starting to build out more of the B2B partnerships, so partnerships with real estate agents and mortgage brokers and the like. But yeah, we just want to keep doing what we're doing and start to do it at real scale.
Love it, mate. Very exciting times. Anything that finally to add in relation to Futurerent that we haven't discussed that's important for people to know?
I think that's a really great overview. I mean, we're really about just giving people a simpler, better, purpose-built solution.
Yeah, absolutely love them, mate. Without the headaches and the hurdles that the banks keep increasing, yet alone and adding to them, unfortunately. Now, love that, mate. I'd absolutely congratulate you on the innovation and the ease. What I love about this is, as we all know, property, particularly when you're talking money, can be a very stressful exercise, and the uncertainty around being able to get your hands on the money is one of the biggest issues that investors face. So you've just removed a significant number of those hurdles and the stress, time and complexity that's associated with it normally. So I'd absolutely take my hat off to you, mate, and really very supportive of the initiative that you're driving there. Mate, I want to switch now into what I affectionately refer to as the ambush round, or the fast five questions that all podcasts tend to hit their guests with. So to share your words of wisdom, what's your favourite quote and why?
Well, it's actually probably a tweet, right? So there's a tweet by a guy called Naval Ravikant, who's the founder of AngelList in the US, and it's play long-term games with long-term people. All returns in life, whether in wealth, relationships, or knowledge, come from compound interest. And I love that, because people, they usually think about compound interest in terms of just investing, and they think about investing in terms of just the asset, right? But it's so much more than that. It's the knowledge that you've got, it's the experience that you've got, and it's by specializing and getting that accumulated experience that people are able to actually start to do really, really well.
Totally agree, and that you've made a really good point there, because growth in anything, I've always said growth in anything is exponential, and it means that you'd see very little results for it early on, but if you hang in there long enough, then you really reap the rewards. And it's not just the physical rewards we're talking about. It is that investment in your knowledge, it's investment in relationships and in networks, and it's that combination of things that ultimately then create sustainable success in whatever you're achieving. So, that's a great quote, mate. I haven't heard that one before, and that is an absolute cracker. Mate, turning to the literary field then, what's the top book that you'd recommend people read and why?
I'm a big fan of Thinking Fast and Slow by Daniel Kahneman. Yeah. And I love it because I think it helps people see the world as it really is. And that often requires people to overcome biases and overcome their initial gut reaction and slow down and actually really think deeply about whatever situation or investment or whatever it might be. So I think it's a really good one, because it's not just investment related. It applies to so many aspects of your life.
Totally. It's one of my favourite reads, and I 100% agree with you. Unfortunately, we live in a world of faster, bigger, better, and doesn't really encourage or allow that deep thinking time where you sort of take time out and really contemplate and meditate on what is the right course of action. But those who are smart enough to do that always make much better choices and much better decisions as a result of that, mate. So, yeah, that's a cracking read. Mate, this next question is a little bit left field, but most Aussies still believe they pay way too much tax. So what's the top legal thing that you've done to minimise the tax that you pay, Godfrey?
Probably maybe a good one for some people, but not for others. But start a startup. You won't make any money, at least for the first few years, right? So that's one way to do it. So, but no, look, jokes aside, I think the biggest thing is don't sell, right? You don't need to sell. Keep the property and recycle the capital, right? It's when you can defer that and defer that and defer that. I mean, that's all that the tax game is in Australia. But when you can defer that by not actually selling, that's when you can really get the benefits of that compounding.
Yeah, absolutely agree, mate. That's music to my ears, and 100% agree with that approach. Back on the investment arena then, what's both the worst and the best piece of investment advice that you've ever received today?
Look, I think the best piece of investment advice I received was pretty simple and pretty early in my career. I remember sitting down with a sort of colleague at a pub, and he basically was just banging on, telling me that it's just all about leverage, and telling me to just borrow as much money as I possibly could, as long as it was money from the bank, residential mortgage debt, right? Yeah. And, working in that area, I really began to appreciate the differences in terms of the different types of debt, right? But that kind of debt is the safest, most stable, secure debt you can ever have, and it doesn't appreciate as long as you are buying an asset that can generate a great enough return to pay that cost of funds, right? Yeah. Which at this point in the cycle is very, very easy to do. It's all about leverage. I think often that feels risky for people. It feels uncomfortable for some people. But as long as you're investing in assets that can pay you a good enough return to cover the cost of that debt, then it's the type of thing you often do want to maximize. Obviously, I'm not giving investment advice here, but I think that is probably the best piece of advice I've ever received.
Yeah, I totally agree, mate. And I guess the unseen and the hidden aspect of that is that, as you well point out there, by leveraging into debt over time, inflation and the growth in the property value actually minimises that debt position. So what might feel expensive and scary now diminishes over time. And a quick example of that, the very first investment property that we bought over 20 years ago bought a property for the princely sum of $84,000, and we borrowed 97% of that then because you could. So we're only talking a bit over 70 grand in terms of borrowings. That property now's last valuation just recently was about 650. And we've pretty much eliminated that debt. And at the time, it was a bit scary for us because that was our first investment, and we weren't really sure how that was going to go. But if we look back now at the cost of that rent against the cost of that debt against the rental income and the growth and the value of the property we achieved, it's nothing. So that's absolutely nailed that. And it's not only leverage of money, it's leverage of other people's expertise. So I've always say it's other people's money and other people's knowledge that also contributes to it, but all comes back to leverage, mate. So that's awesome. What about the worst piece of investment advice you've ever received?
I think there's so much bad advice out there, especially even in the superannuation space. I had my super with one of the groups, which ended up, I wasn't even a party to it. There's a class action against the bank-led sort of super group, There's just such bad advice out there, like in relation to super. I now have all my super with just basically low-cost ETFs, right?
Yep.
And the amount that you save in fees is unbelievable, and the returns that you actually get, especially if you're someone like me who's still, in the sort of accumulation phase. I'm not planning on accessing my super for a very long time. So really, I can withstand the short-term volatility. So I'm much better off, me personally, going for more of an equities exposure rather than diluting it with gold and fixed income and all this other sort of stuff, which I know over the long term is going to generate much lower returns.
Yeah.
And it's incredible, like, even when I sat down with the financial advisor, which was compulsory to do before I switched everything into to ETFs, they were trying to convince me not to do it.
Of course they were, because they're not going to earn any of your hard-earned coin.
Yeah, it's unbelievable. So you've got to have your own mind, for sure.
Very strong vested interest in that area. Mate, final question then in this Fast Five round. What's a personal happy habit or a daily discipline or a rewarding ritual that you've embraced that's contributed most to your investment success today?
I think the closest thing that I've got is really about thinking creatively about your investments, which for me has been a really powerful thing. And there's always a million ways to skin a cat, but if you go back to first principles with everything, and if you ask the why on everything, then you can usually find a solution or cut a deal, right? And I think that's something you can do, in so many different aspects that you're doing. And if you don't understand the why, then you're missing the picture.
Yeah, love it. Love it. Beautifully said. So the final question then that sort of allows you to put a big bow around everything we've spoken about. If I gave you a microphone that spoke to every single one of the 7.7 billion odd people that are currently alive in the world, and I gave you a minute to talk, what would you suggest they invest in?
Look, I think it sounds cliche, but you've got to invest in yourself, and you've got to look at your own property investments as a holistic business that's more than just the property you buy, right? It's your personal income put together with your loans, put together with whatever equity capital you've got. And if you can line all of those things up, and you can do that successfully to invest in property, then even if you just get inflationary returns, 2-3% a year, the return on your equity is going to be phenomenal, right? And it's going to be something that most fund managers are going to struggle to replicate. And it's something that you, as an individual, can do yourself.
Yeah, I love it, mate. And again, you point out something that most people overlook, and that is the return on money invested. If the bank's carrying and doing most of the hard and heavy lifting on a property, then if you look at the real cash-on-cash return, then there isn't an asset in this country that will outperform property in that context. So, love that, mate. Been a really great conversation. Really opened our eyes to the exciting opportunity that Futurerent brings. So for those listeners who are pretty keen to investigate further the Futurerent opportunity, how can they get in touch with you, mate?
Yeah, so I guess they can drop us an email anytime at hello@futurerent.com.au, or otherwise they can feel free to give us a call. We'll head to our website at futurerent.com.au. We'd love to hear from you. We're talking to investors every day, we'd love to see if we can help any of your listeners do more with their rental income.
Yeah, fantastic. I'll certainly also be encouraging any of the listeners that are finance brokers or accountants or buyers agents and some of the real estate fraternity to reach out to you as well, because as an opportunity opening potential, the Futurerent exercise has some real power there to free people up to really start turbocharging the growth of their portfolio. So, mate, been a great chat. We'll stay in touch. Appreciate you coming on board today, and I know that the future's looking very rosy for Futurerent.
Thanks so much, Bushy. Such a pleasure.
Thanks, mate. We'll stay in touch and talk soon. To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die